What's your credit score? 720. How long you been on a job? 5 years. We're good to go. All right, welcome back, ladies and gentlemen. Today I'm going to do the simple little tip that I've been wanting to do, but I had to do the first couple to get to this point. This is one of the most amazing things that I have done in my 98-year career in real estate. And basically, I'm going to tell you how I can tell somebody if they can qualify for a mortgage in 1 minute within I'm going to say 90% degree of accuracy, okay? Now, I love the lenders. Everything you do is absolutely correct. I am not in any way contradicting lenders because you have to go through the whole process. I have just come up with a method that I feel very comfortable how I can tell you in 1 minute if you can qualify for a loan or not. Now, you can do the same thing if you're thinking about buying a house and trying to decide if you can qualify or not, or if you're a realtor talking to a potential buyer or somebody. But first of all, we just finished celebrating Mardi Gras. We take that very serious in Louisiana. I asked my wife a couple days ago, I said, okay, Mardi Gras is coming up. What are we going to do? She takes it very serious. All right, you ready? Every home loan anywhere in the United States of any kind comes down to three things. 95% of the time, the first two, it's done in 15 seconds. Number one is your credit. What is your credit rating? 90% of people know that. What is an acceptable credit score? The lowest credit score, in my opinion, is 580. That's kind of the bottom. Most lenders want, I'm going to say 640. Conventional loans, 680 or so. 580 or up. Ideally, 640. Above that, you're good. Number two is the continuity of your employment, the stability of your employment. Most all lenders, most all loan programs want to see 2 years in a similar line of work. Doesn't have to be the same job. If you've been to college and you graduated from college and with an accounting degree and you took your job, you've been on your job for 6 months in accounting, they will use that education. Now we're down to the third thing. We're 2/3 through. The third thing is your debt ratios, your income versus your debts. They look at your gross income, not what you take home, but your gross income. Again, 90% of the time, it's 5 seconds. Do you know what you make monthly? We know there's 2,080 work hours in the year, 8 hours a day, 5 days a week, 40 times 52, 2,080. So somebody says, make $20 an hour, 40,000. Pretty easy to figure their gross monthly income. That's half of it. The other half is the debts. Now, most loans have two ratios they look at. The industry calls it the front end and the back end ratios. I call it the housing ratio and the total debt ratio. The front end ratio is your new proposed house payment as a percentage of your total gross monthly income. Now, yes, that varies, but I round that to 30%. So if somebody says we make $8,000 a month, then in my opinion, you can go up to about $2,400 a month in your total house payment. If you didn't listen to my last podcast, I prepared for this. In the market right now, and this is going to last, I think, another 6 months at least. This would have worked 6 months before. It'll work 6 months from now. For every $100,000 you borrow, your principal and interest payment is going to be about $650 a month. If you want a $200,000 house, that's $1,300 a month principal and interest. Then you add your taxes and insurance. I arbitrarily add $300 or $400 a month to that. Again, the first thing I asked somebody, this is on my last podcast, is what is the most monthly payment you're comfortable making? And then we determine how much of a house they can buy. That's the first thing. Okay, the second ratio, your back-end ratio, or in my opinion, your total debt ratio, is your proposed house payment plus other fixed monthly obligations. Bank loans, car loans, credit card debts, your fixed monthly obligations that you owe money to. They total those up. They add that to your monthly payment, and there's a ratio for that. Now, some lenders do, some lenders don't. But I'm going to say 50%. Your total proposed house payment, new house payment you're going to have, plus other fixed monthly obligations that you have, those combined should not exceed about 50%. If you're making $8,000 a month as a family and you can go $2,000 a month on your house payment, then 50% of that $8,000 is $4,000 a month minus $2,000. That leaves you $2,000 a month for other fixed obligations. 90% of the time, people buying a house, they don't have 10 or 15 debts. People buying a house typically have good credit, typically pretty stable. I'm going to just throw out that the average person buying a home has maybe 3 to 4 monthly debts. What's your credit score? 720. How long have you been on a job? 5 years. We're good to go. And then number 3, what's your gross monthly income? What are your other fixed monthly obligations that you pay? And you add those together, go 30% on housing, go 50% on the other. All right, you got it? Credit, cost of employment, debt ratios. God bless you, stay out of trouble. And you always get an extra, so click on the link here. You'll love it. Went and played golf yesterday, shot an 85. Went home. My wife had my bags packed, said she was kicking me out if I didn't straighten up and start acting right. That bothered me a lot. I thought about it. I know I can shoot better than 85. Maybe just a bad day, I don't know. Maybe I need lessons, new clubs, but I welcome any help, any suggestions you have to improve my golf game. Y'all let me know. God bless.